Okay, so we got the recording going. Hey, Tyler, we just I did a video overview of a real live syndication that funded and took place the Lavender Meadows deal. So that was kind of fun to kind of do a fly around of yesterday's site visit. We got out there with the drone and looked at it. It's a big project, 38 acres, 217 homes, and that delivers next summer. So
Wow.
if you guys know any buyers, we're going to have a lot of inventory, and inventory is tough to come by as a buying agent right now. Everything's on the
What
market.
kind of what
Yeah,
kind of units are they?
manufactured homes.
So buyers of manufactured homes or the community?
Yep.
Okay.
Manufactured homes. Yeah, good question.
Okay.
Yeah. So about 225 to 250 a home. So
Okay.
anyway, I don't want to turn this into a sales pitch on buying manufactured homes, but um,
Yeah.
yeah. So tonight we're talking real estate fees for a syndicator. Um, you know, uh, I think this is a really important topic because people have to get paid. People have to make money to stay interesting, or to stay interested and stay
Mhm.
aligned with the deal. So, for example, one of the things that I prefer is that you're kind of full time dedicated to doing a syndication when you're taking people's money and things like that. Well, you may not be getting paid for the deal as a syndicator or as an operator until the deal sells, which could be 5 years from now, right? So, the question becomes, how do you make money from the time that the deal starts to the time that the deal sells? And then, sort of, what's kind of expected, what's typical, what is market, and things like that. And that's really what we're going to get into tonight. So we can throw the presentation up here in just a second, but I just kind of wanted to get that out of the way because there does you do, when you invest in a syndication, you want to make sure you understand what that syndicator does to eat, right? To
Mhm.
put food on the table, to
Yep.
to focus on your project. And the other thing is, does that syndicator have the resources to hire a team to actually complete the project that they've signed up to do?
Mhm.
And that's where these fees come into play. Personally, if I look at a syndication and there aren't fees being charged to the operator, I get suspicious, because maybe they're signing up for something that they can't manage. Likewise, if there's a lot of fees and there's a lot of split on the back end, I might get a little bit suspicious of that, where the syndicator is being maybe a little bit too aggressive in how much fees and how much split they make. So, you guys have anything to add to that?
I'll just give you an anecdote of a conversation I just had with a builder and 30 minutes ago at Bellevue Brewing Company. If you're familiar with it, where that
Yeah.
is, he just took 2 months off. He finished a few projects in March, May timeframe, and he just took 2 months off because he was so tired of supervising his own projects. And he's got ongoing projects, but he's not there. So we hired somebody to like check in with them, but he's not there himself. And that's a reality in this business. You get burnt out. And if you're not compensated well for it ongoing, then you need those vacations. So just a reality. If you want peace of mind, right, you need consistency. And those
Yep.
fees provide consistency. And it's almost like a replacement cost as well. But we can go into that. Hey, if somebody else were to do this, what would they charge? If it's within kind of a margin of reason, then that's appropriate. But just a reality of that the business is kind of tough. Managing your own projects is tough. If you want some peace of mind, you either need to be there day to day and be compensated for being there day to day, or you need to find your peace of mind by doing absolutely nothing, which is kind of the role of the passive investor, to make their money work for them, as opposed to dealing with those headaches. Because you can be in whatever role you want to be in this business. You can be the property manager, you can be the asset manager, you can be the syndicator, you can be the investor. But it's hard to pull yourself away and actually achieve peace of mind.
You
Be-
brought up one thing I
yeah,
wanted to touch on, and that's
yeah,
having the fees charged to the project so that you can replace yourself. And I think that is such an important point. So like with the Lavender Meadows project, the one we showed at the beginning, when the contractor is part of the partnership. And the first thing I told the contractor when the partnership was coming together was, that's great, you're part of the partnership, but I need to be able to fire you and hire somebody else.
Yeah.
Right. Yep. And if I'm not paying that contractor a fee, then I don't have the resources set aside to actually pay that contractor a fee, right? So if he's doing a bad job and he's not meeting his deadlines to build the project, guess what? I need to fire that contractor and I need to put a new contractor in place, and that contractor is going to charge a fee. They're going to charge usually a cost plus or a GMP, guaranteed max price bid. That's usually somewhere between 3 and 10% of the total construction cost. And if you haven't accounted for that, and you need to fire that contractor that's part of the partnership or somebody in the syndicated operator, you're going to have the budget to go hire someone to replace that. So if somebody's not charging a fee, I sort of get a little bit suspicious, and I need to know kind of the whole picture. Sometimes, there's groups that don't charge fees because they might have a supplementary business like a law firm or a CPA or something like that. They say, well, we don't charge fees because, we're aligned with you and this and that, and we don't need to charge fees. And maybe it's because they have a supplementary business. But but again, where's the focus? Is it on the deal, or is it on the alternative business? And are they a full-time specialist? So again, sometimes you might hear, I don't charge any fees, but kind of get the perspective of, kind of where their focus is and what they're doing. So, well, we have a presentation tonight. So let's go ahead and get started on that. So first of all, I wanted to say, thanks everybody for coming. We try to, the whole point of this meetup group is to expand passive investor education. Not to go buy your own rentals or buy your own property and manage everything, but to really be a better, sophisticated, full-time, active real estate investor. And so that's what launched this group. That was the whole point of it. I gave a presentation at a local meetup once, and a gentleman came up to me after and said, where can I go to just learn about how to invest in deals and sharpen the axe? And that's really what started this. So myself, my name is Ryan Gibson, and I'm with Spartan Investment Group. We have Tyler Thomas and Igor. I'm not going to butcher your last name, Igor. Can you say it?
Pechkovsky.
Okay, very good. I'll learn that better. But we all kind of put our heads together and started this group as a way to, better do real estate syndications and things like that. So, all right, yeah, and feel free to chat in the chat box. If you have a question or if you can't hear us or something like that, definitely feel free to pipe in on questions and things like that. So, all right, so why we started this group, we just went over that. The mission here is to enhance passive investor knowledge in the greater Puget Sound region. We wanted this to be local to Seattle. This is, we're going to have one in Denver. We're going to have one in Seattle. Really wanted to make this in person. And with COVID, that's kind of been put on hold. We actually have a meetup space for when we get back together. And, we hope to build a community of investors that is focused on, really good due diligence on syndications and a high level of education. And then eventually we want to bring in other operators and deal sponsors, and we want to look at some live projects, and talk about what makes sense. Does industrial flex make sense? Does storage make sense? Does residential development make sense? Whatever it might be, we want to be open-minded. There's not a lot of pitches or anything like that to this. We do have a YouTube channel now, and the name of the group is Investment Syndication Simplified. And this will turn into a podcast. So if you're listening, this might already be a podcast, but we are going to be putting this up on a podcast. And it's focused on passive investor education. And this will be both a live and, for now, online meetup. So what is a syndication? We've talked about this. It's pooling your money together and partnering with an operator or a syndicator. So you join a team of experts, and you could syndicate anything. You can syndicate a self-storage, a multifamily, 400 unit apartment building. You can syndicate one single family. You can syndicate, 100 single families. You can syndicate a Broadway show. You can syndicate a musical, a movie. You could do pretty much anything with syndication. It's the act of putting together money, to collectively do something much larger. So, for example, we just raised $4 million from, I think, about 40 investors or so, maybe a little bit more, a little bit less, and we're taking down 1,800 units of storage, and we close in 4 days. So that's an example of buying a 4 portfolio property with tons of efficiencies and an experienced operator, that allows you to take advantage of a bigger deal with bigger scale, without having to go come up with $4 million yourself, right? That's the idea, is that you don't have to learn all these things and nuances and, work, 40, 50, 60 hours a week in real estate. And the reality is there's a possibility that you might get the same return on investment that you would get doing it on your own. Obviously there's no guarantee of that, just like anything in real estate, but the reality is sometimes you can do even better. So tonight, what we're talking about is fees. How a syndicator. So basically, a syndicator is going to make money up front, on a fee, and then they're going to make maybe some money during the deal, and then they're going to make a split at the end, or maybe even some disposition fees at the end. I put some words up on the screen here. I won't read them to you word by word, but essentially, it's the fees can be kind of charged based on the performance of the asset, or fees could be charged based on how much the total project costs are. That's kind of the two ways to do it. You got typical fees: acquisition fee, property management, project management, asset management, and disposition. Disposition means, when you sell the property. And Igor or Tyler, feel free to chime in. We only got a few slides tonight. We're not going to talk for hours and hours and hours. We want to make this about networking and questions and things like that. So these are the different types of fees. Acquisition fee. So imagine if you buy a property. I'll give you the Tyler Longview example. So we just bought 4 properties in East Texas, 4 storage properties, and we charge an acquisition fee. So this is, it depends on the size of the deal. It's paid when the property closes typically. So as soon as that operator buys that property and closes, so we close on August 31st, there's a fee that's paid to the sponsor. There's a fee that's paid to the operator. And that's usually charged one time at closing. And in our case, we charge anywhere between 1% and 3%, depending on the deal. So when you look at acquisition fees, you want to really understand how they're calculated. In our case, we calculate them based on total project cost. So the asset in this case was $8 million, but we've got another $3 million in various fees or various expenses, such as, we're expanding one of the properties by $1 million, and we're improving one of the properties by $800,000, and we're putting money in the bank for operating reserves. And so we charge that it totals to 11 million. So even though the property is 8 million, the total fees are 11 million, and we charge a one-time fee on that $11 million paid at closing. So in this case, this deal was a 3% fee, and we paid $300,000 to the operator at closing. Okay, so where does that go? Where does that go, right? What are the red flags, right? So if an operator is a one-man band and he's doing it all himself, nothing really wrong with that. But I would want to kind of see a team behind that, right? What employees, what staff, what resources, what do they have behind them that justifies that fee? In our case, the fee is going to pay for our 15 employees at corporate, and the 15 employees at corporate are servicing the project in some way or shape or form. Somebody took the time to organize all the equity. Somebody took the time to find the deal, and our property and our ops team is transitioning the property. So all 6 of them are going down to Texas for the next couple of weeks and spending time transitioning the property. All of those folks have salaries and bills that are associated. That's where that money goes. That money gets consumed pretty quickly by our organization to basically run the deal, right? Makes sense. Anything you guys want to add to that or say?
Super straightforward, just the way you explained it.
Just to separate something, Igor, the acquisition fee isn't a commission. It's not a commission, it's the operator's fee, correct?
Yeah, that's exactly right. That's actually a really good point. So a real estate agent might have brokered the property to you. That's just in the final sales price, right? That's completely different. This is the operator saying, I found this deal, I organized the equity, I'm taking down the asset, I've got the transition team, this is my fee for keeping the lights on to find these types of deals and deliver these types of offerings to you. So I'm going to go into the weeds for a second. So for example, we send out investor binders to all of our investors, and we send out monthly emails and quarterly emails and prepare a bunch of things for our investors. That is a cost, that is an overhead cost to our business, right? So that doesn't come out of the expenses of the project, that comes out of the overhead of the business. So a lot of those fees that we charge kind of go to those types of things, but primarily salaries of the employees that run the deals, right? Property management fee is the next one. That's compensation for managing the day-to-day operations. So imagine that you, this may or may not be charged by the operator. So let's say you hire a third-party property management company. So in our case, we're in storage. So if we go to Extra Space or CubeSmart or Public and say, hey, we want you guys to operate our business, or if you have a single-family home and you find a property management company, you might pay them 10%. But if the operator acts as the property manager as well and collects the rent and finds the tenants and manages the property day to day, the operator may collect that fee. But it should always be either or, either hiring it out and you're paying somebody else, or you're doing it yourself and charging a fee to do it. It shouldn't be both. You don't hire out a property management company and charge the fee, right? Because then you're double charging the property. You should look out for that and make sure that the operator isn't doing that, but understand how that works. So in our case, we do all of our own property management. And if we didn't, so let's just say, our property management team all quit and nobody wanted to do this anymore, we would have a budget and projections that allowed us to bring in a property management company, pay those fees. Project management fee is the fee charged for managing an expansion of a ground up, usually a percentage paid at closing, and it's kind of spread out during the project. So in this case, you might have a project that you're building something. So like we build storage, we build manufactured housing parks, we build RV parks. We'll charge a fee just like a contractor would to manage that process. So some operators, they'll charge a fee. If you sling a new AC unit on a building, or if you go and replace the doors or go and do something, they'll put another line item in there for project management. We don't get quite that granular, but that's something that goes on that, just be aware of it. It's not, unusual, and it's not unreasonable to charge a project management fee, because again, that usually means that they have somebody sitting in their office or on their team that they're paying to do those functions, to call 3 contractors, to get them to come out to the property, to develop the project, to do the site visits, right? You have to pay for those types of things. Asset management's the next one. The asset management fee is really this is typically something that we always charge, and usually it's either a percentage of gross revenue, or it's a percentage that's paid annually based on the total project cost. You can kind of do it either way. And asset management fees, managing the capital, reporting distributions, looking at financing, looking at budgets, coordinating strategic initiatives at the property, managing CapEx, managing OpEx. It's kind of like the quarterback or the CEO of that particular project and all the functions that go along with it. So it's kind of like all the things that you do to coordinate the project. Disposition fee is just that. It's paying Igor to sell the property. So let's say, I have a self-storage or a home that I want to sell and it was part of a syndication, and I hire Igor to sell my property, right? He's going to collect a 1 to 3%, maybe even a 6% fee for selling the asset based on what he sells it for. But if he does it, then those fees, that's where they would be expected to go. Igor would collect those fees and I wouldn't get anything. However, if I if I act as the broker and I spend time, making calls and finding buyers and sending out flyers and marketing the property, sometimes the deal sponsor will take those fees and they'll have those fees listed. So I would, the big takeaway here is whenever you have a syndication that you're investing in, understand what fees the operator is taking, and just know that it's okay that, an operator would charge fees to do the project. Just make sure that they're not excessive, and make sure that they're, kind of compensated for what they do. The most important thing, though, is legally the operator has to disclose any fees that they make from your syndication. So let me say that again. Anytime you charge fees, the operator has to disclose those fees up front, or they cannot charge them. So, for example, if I, put together a syndication and I don't say that I might charge a disposition fee and I go broker the deal, then I charge 3% later on, that's a big no-no, right? We disclose all of these fees up front and what they are, how much we would make, and how they're calculated. That way, even if we don't charge them or act in that capacity, we have that ability to charge those fees, and we've disclosed them to our investors up front. This is an example from our project. This is a real live project. So we charged a 3% acquisition fee, and I don't know if you can see the small print in the bottom, but I'll read it out loud. Acquisition fee is calculated based on total project costs charged one time. So total project cost was 11 million. We charged it one time. And then the next one is project management. Project management are calculated based on the total project costs charged one time. And project management fees, I like to see the operator spread these out over a period of time or pay them at key milestones complete. I don't like to see, I take all the project management fees and then I disappear. And I don't manage the project, right? I like to see these kind of metered out when, ideally when key milestones are complete in a project, or just on some kind of regular basis to cover overhead for the operator. Asset management fees are calculated based on total project costs per year paid monthly. That's one way to do it. The other way to do it is if the business makes $30,000 a month in gross receipts of revenue, then they might charge 1% and make $3,000 a month for asset management, right? That could be another way. And that doesn't hurt the property's value, right? That is net ordinary income. That's below net operating income. That's kind of the fees paid to a sponsor. So it's not like those fees are hurting the value of the asset. So that's kind of important to note as well. Property management, super self-explanatory. We charge 5%. A standard self-storage operator charges 6%. So we actually come in a little bit below that. This is kind of a double-edged sword, right? I mean, on one hand, property management companies making a little bit of money on the property management. It might be better to outsource that to a third party in some cases. In our case, we like managing our own properties because we are aligned with our investors because we're running the asset, and we don't just care about collecting a fee of gross. We care about the NOI because there's a split on the end, right? So our alignment is very close, and not just collecting a percentage of gross, but knowing what the NOI, what the net profit is for a specific investment. And then the disposition fee, again, it's the fee if we sell it. So we kind of categorize to the right, to the left. To the right is kind of like what we might charge, and to the left is more like what we are charging. So third-party fees on the right, and then kind of what we expect to charge on the left. And we talked about this previous slide. Here's some industry norms. Acquisitions 1 to 4. Property management 5 to 6. Sometimes it's a little bit lower. The bigger the check size, the lower the fees get. Project management, 1 to 3%, asset management, 1 to 2%, disposition, 1 to 2%. So, pretty average things here. There's a bunch of fees that are listed, and maybe we talk about them later, but there's a whole bunch more fees that operators can charge. And one of them is a financing fee. So a financing fee, let's say the operator is signing on a loan and the loan is a recourse loan. The recourse loan comes with a lot of risk. So for example, the Tyler Longview deal that we just did, the self-storage portfolio, there's a $7 million loan associated with that. And it's I think it's partially recourse and partially non-recourse, if I remember right, or maybe it's all non-recourse. But now the operator's on the hook for that loan, and they may charge a fee to sign on that loan, and that could be anywhere from 1 to 3% of the loan size. So it's something to be aware of. That financing fees are a fee that operators tend to charge. So just be aware of it. It's another fee that's out there that you may or may not charge. Red flags. So, it's kind of a catchy slide, red flags. It sounds, alarming or something, but, what is the operator earning? So, I tell my investors, or people looking at syndications, it's like, what's in it for you, right? What's in it for the investor? Are you, taking on a moderately risky opportunity and making 17% annualized or a 17% IRR? You're getting a great return. And then when you look at the deal, you like the strength of the operator and the project and the likeliness that you'll get to that return. So you ask yourself, does it make sense that the operator is taking the fees and the splits that they're taking? And you may not care because the return might be so good that it just and the deal makes sense that you're just happy to be part of the opportunity. Sometimes if you don't really like the return and it's kind of low, and the operator is taking a ton of fees and a ton of the split, you might not like that. Or you might see an operator where they take all fees, right? They take very, very high fees up front and they give the investors all of the split. And you might say, that sounds interesting. They're taking all these fees up front and they're not taking any of the split. What would be a red flag in your mind? Any comments?
Well, they're gonna grab the money and be in Ferrari tomorrow, and
yep.
that's about it.
Unfortunately, I've been victim of one of these deals where tons of project management fees, tons of acquisition fees, the Facebook posting of the Maserati the next day, and a project that fell into turmoil for the next 4 years. Right? That's I want to know who you're hiring. I want to know who you've hired. I want to know who's on your team, right? And if it's a bunch of people that you have yet to hire, I'm skeptical. If they're already on your staff, or you can kind of specifically talk about it, great. And I'm not talking about hiring an architect and a civil engineer. I'm talking about people on your core team that are working for you, right? Those other things are just expenses to the project that you would normally pay. So you're exactly right, Igor. High fees and no incentive after the fees, that's an operator that's going to make their money and run. So it could be. It could also work the other way. But I like to see a little bit of incentive for the operator to do a good job with the deal after the deal is closed. Next thing we talked about, when do the project fees get paid? Are they getting them all up front the day you close, turn and burn, everybody runs for Hawaii? Or are they kind of trickled out and reasonable based on the scope and the size of the project? We have fees versus risk return curve. So, if it's a super risky deal and your returns are kind of low, and their fees are kind of high, and you just kind of got to find your comfort level with what the risk of the project is. Is it ground up construction? You look at the Lavender Meadows project. That is ground up construction. That's probably as risky as any project gets. You'd expect those returns to be a bit higher. Where if it's a stabilized storage deal or existing multifamily, the risk kind of goes down a little bit, right? So, it just depends on the risk return of the deal. Total percentage of compensation, is it based off of fees or upfront? So, um, are you getting all, like you said earlier, are you getting all your money up front, or are you getting on the back end, or do you get some, while the deal is being operated? So, just some things to think about. Any other red flags that I missed?
One thing, Ryan, is it's a little bit difficult to conceptualize these subjects without seeing like the full spectrum. So in the future, or maybe at the end of this talk, we could talk about examples where we could say, well, this is a little bit teetering on the side of a little bit, unfair. Or, oh, this is something, that seems really fair. Let me look deeper. And maybe we could just talk about a few examples across the spectrum.
Sure. Yeah,
The best way for that would be, because it so depends. Like you just have to look at a particular deal and really see, like to review the deal and see how are they charging things and when, right? And say, hey, this is look good. This is a little abnormal. Could be a little better, but and so on.
Yeah, and when you add all the fees in and you put it into if you put $300,000 or a couple $100,000 of fees onto an 11 million or $15 million project, it's really not impacting the investor returns. When you really do the math, it brings the investor returns down 0.03, 0.02. It's inconsequential to the overall return to the investor, but it's so important to have somebody who can, earn income while they operate your project and, be successful at it by having the money to put towards resources to run the project. Super important. I'll give you an example. I was in a deal where the operator was building a facility and they charged no fees whatsoever. And, one guy ran a snowplow landscaping business on the side and did concrete work. And the other guy, I can't remember what the other guy did, but no fees up front, and just not as sophisticated as doing syndications. And the split was pretty big. They took a pretty big split, but I got what I paid for. I show up to the project and they're doing everything for the project. They're working on the construction. They're out in the field. They're the GC. They're this. They're that. And the project is getting built incredibly slow. Because in the wintertime when there's snow to move, they're out plowing snow and they're not focused on the project. So really pop the hood and figure out what is that operator going to do during the course of the syndication to make money. And without fees, I get super skeptical. Just because again, you've got to eat somewhere, right? I don't want my $50,000 investment into an operator and then find that person waiting tables on the weekends at a local restaurant, right? I mean, that's not, I want them, project managing what I'm doing and showing that they're focused on my deal and not doing something else. So good point. Yeah. So we're kind of opened up to the rest of the group. I think what I'll do is I'll just hit allow to talk on everybody. Is that good?
Yeah, go ahead if you got that option.
Guys, I'm letting you guys all allow to talk. So if you are talking and don't want to be heard, definitely mute. So we'll get a good discussion going. There was Mark brought up a really good point. There was a super awesome change that happened in the SEC ruling yesterday, and they changed the definition of an accredited investor. So I guess I should have probably started with that. This was something that they've been working on back since September of 2019. And the SEC is trying to modernize the definition of an accredited investor. Some of the highlights are this. So just to kind of no investor left behind, an accredited investor is somebody who makes $200,000 as a single filer or $300,000 as a joint filer, and they have a net worth of at least, or right, they can qualify either or, a net worth of $1 million or more, excluding the equity in your primary residence. So that could be cash or retirement accounts, but can't include your primary. So that's been kind of the line in the sand for investors for a long time. And it's just been kind of a random line in the sand. It hasn't really been very modernized. So without, tripping up here and saying incorrect things, the highlights that I remember from reading the ruling were as follows. One, you could have a special certification or classification, and that would make you accredited. So, in Mark, in your case, I would probably say that they might deem being a CPA or some type of licensed financial professional to classify you as being an accredited investor. They left that door open, and they didn't really talk about specifically what certifications would make you accredited. Now, they did say that if you had a Series 7, which Ted is on the call, he has a Series 7, that would automatically qualify you as being an accredited investor because you have a deep understanding of financial matters and financial planning and things like that. The other thing that they said was that your spouse could contribute net worth and equity towards the accreditation status. So it kind of modernizes, not having to file joint or whatever, if you have a spouse or domestic partner, or significant other, whatever it might be, that can go towards your accreditation. I think I'm understanding that right. And then the other one was if you're an employee of the fund, you're classified as accredited. And I thought this was really good because at Spartan, we have many employees that want to invest in our projects, but may not be accredited. And it's kind of ridiculous because they know the deal more than anybody because they're actually managing these deals. They're property managing, they're hiring the managers, they're hiring the staff, they know the business plan, they're executing the business plan. They know exactly what they're investing in. So because they're employees of the fund manager or the company that's doing the syndication, they can invest. So I thought that was a nice turn. And I think that's my limited knowledge of the ruling. So anything else that you guys heard, or did I misspeak on anything?
Maybe Mark can touch on this because he's got a
Mark. Yeah,
mind on it.
Mark, you want to unmute?
You guys gonna pick on me?
Yes.
All right. How can I help you? What's going on?
What did you hear
man,
about
it's recorded too.
Yeah. What did you hear about the accredited investor definition changing? What do you know?
I don't know a whole lot. I just saw the headlines. I didn't read the full definition, so I don't know anything more than what you just said.
Okay. Fair enough. Thanks, Mark. Well, awesome. The whole point of this call is to kind of build community. We want this to be, we want to know who you are. We want to know the types of things you're looking for. Do we want to just go around the room real quick? Maybe I'll pick on you. Ted, we're going to start with you. Ted's a really interesting guy. Ted is, it'll be announced very soon, but Ted is the latest add to the Spartan family. So Ted just joined up with Spartan Investment Group on Monday and is helping us in the investor relations side of things, and we'll be rolling out some cool strategic initiatives. So without further ado, Ted, how you doing?
Hey, hi everybody. Ryan, can you hear me okay?
Yeah, we can hear you. Yeah.
Guys, I had a brainstorm early on in the meeting. I wanted to throw this out on the table because it really got my heart going. We've all seen a podcast where there's a loud, flashy intro, and in retrospect, it was all show, no go. To really put some teeth into what Ryan and Igor and Tyler, I haven't had a chance to connect with you, but I've heard Ryan talk about the next couple of years, both for Spartan as well as this group. We should be inviting compliance officers from registered investment advisors who are protecting and serving their investors in a fiduciary capacity. We should invite the advisors, compliance officers that are soliciting private placements for investment, because we could really build a cool ecosystem that amounts to a middle market. Middle market is generally 50 million and above. If you bring a couple of advisors together that have an appetite for deals and are looking for deals, you will attract high quality operators, you will attract real money, and the group could really grow. And when everybody is playing above board and in broad daylight and mindful of SEC exemptions and rules and accountability, and there's energy and there's excitement and there's real money happening, that would be really cool. So I didn't say anything about myself or Spartan, but I just puked out what I think is something more interesting than me.
Yeah. Yeah.
I mean, I think that would be cool. And so that's my 2 cents worth here on a Thursday. And by the way, Mark, you and I connected several years ago in Factoria with Joe DiDomenico. And so it's nice to see your name.
Oh, I remember that.
Yeah. Fun to connect with you.
Yeah, just a little bit of a plug, and maybe I'm putting the cart before the horse a little bit, but Spartan is actually rolling out self-directed retirement account services, and Ted is part of that initiative. So very good. Steve Clark, my neighbor and fellow hiker last week. And Steve is, I don't know, Steve, if you're able to unmute and introduce yourself, but feel free if you guys are busy, or think noise in the background, it's no problem. Steve's got a really interesting role. Steve is a broker for selling townhouse development sites, big high density residential in Seattle, and has a background in telecommunications. And anyway, Steve, take it away.
Yeah. Hi, everyone. Nice to meet you. I've met Ryan through his project going on down in Black Diamond, and then turned out that we lived about 5 houses away from each other. So, well, I guess a couple more blocks, I should say. But yeah, the reason why I'm interested in syndicates, it's really why I got involved in real estate. I got my brokerage license to learn the business from a transaction side, and been working on my CCIM certification so that I just get more involved in the deals and working with long-term investments and getting into the ownership side. So I'm glad to meet you all, and it sounds like a real diverse group.
Great, thanks, Steve. Sonja, do you want to go next? And Mark, we'll have you go after Mark Zahora. Sonja, you want to introduce yourself? I think we met through this group, so.
Hey there.
Yeah.
Hey, this is Sonia.
Oh,
I met Igor through some sort of, I don't know, Igor, where we met, but Igor's awesome. And my interest in this group is just learning how to invest my money more effectively. Yeah, just here to learn. This is a pretty new space for me, so I don't really have a whole lot to contribute at this point in time, but glad to be here and glad to be learning from all of you. Thank you.
You're in the right place. Sorry to mispronounce your name. Sorry about that.
Oh, no problem.
I'm like the worst. No, this is great. Perfect group for that. And, again, hopefully we can all meet in person, and we're going to have some really great speakers at some point as well, who are focused on the topics that we all want to learn about. I was just speaking with Ted today. We're actually going to have somebody come in from the Department of Financial Institutions, so a state regulator, come in and talk to us about, some of the things that they're seeing, some of the things to look out for, and because this is a very trustworthy space, and we want to make sure that we're all sharp and vetting out operators and things like that. So
cool.
Great. Yeah.
One thing I might add,
Sure.
I mean, I guess what I would really be interested in now is like, I'm definitely a starter investor. So, you're talking about like an accredited investor, and yes, I totally aspire to be at that level, but I'm not there yet. So, would love to know more of like, what are some Kickstarter projects that someone like me can get involved with, and really like know what I'm up to as well, like be able to do it in a smart way that I've kind of been dabbling and just learning about all of this for a while now. So I know enough to be dangerous, but I don't, it's a pretty dangerous area, very risky to get involved in some stuff, especially if you don't really know what you're doing. So, I mean, I think though, just to kind of give some feedback, like, not sure who the group is really targeted at, but that's what I'm looking for, is like as a place to learn and a place to get started and a place that I can do it with, like, you know, either trustworthy people or know that I can actually make some contacts that can help me get started in a helpful way.
Perfect. Yeah, that's exactly what we're here for. And great feedback. We'll get that into our agenda so we can, you know, really hit what you're looking for. So
Awesome. Thank you. Thanks so much.
yeah, you're welcome. Mark?
Hey guys, how are you? Mark Z here. Can you hear me okay?
Yeah, loud and clear.
I am sitting on my deck with a cigar, so I'm outside.
Oh, nice.
Just wanted to say, also it's somewhat like Sonia, I'm a newer investor, learning a lot here. So I really appreciate the kind of walkthrough on the fee structures. That was really helpful to understand what those mean, your perspective on them. And I guess, you know, my background, I've got some single families I'm doing post-tax. And then as Ryan knows, I'm part of that Texas storage project that we're doing here with an SDIRA. But one of the questions I thought of related to fees was, you know, you gave some estimates of what they typically are and some description on when you might be concerned. But is there somewhat a rule of thumb? If I was to look at a prospectus and say, you know, percentage of overall against fees, is this, you know, a threshold where I might want to just move on to the next project?
Tyler, Igor, you want to take it or you want me to take a crack at it?
You go first, Ryan.
You know, there like some operators might say, it's always like this. This is what I always do. This is industry normal. This is how we always do it. And, you know, and there really is no industry norm, in my opinion. There's a way that groups do it, but you know, we tend to structure a little bit differently, project by project. And you know, frankly, you know, my advice is just, you know, my kind of, you know, the whole point of us kind of bringing out this presentation is, you know, this is you know, one of those things that you want to just know that there are being charged fees. So you're aware that those fees are coming out and when they're coming out, and know that you should be disclosed what those fees are. When it you know, what's typical, it just depends. You know, it really depends on the deal, it depends on the operator. I wouldn't say that, you know, well, typically the average is 2% or, you know, and there's really no way for us to get that data. It was more just a kind of an awareness, you know, if the returns are so low, the risk is so high, they're charging a ton of fees and they're taking a lion's share of the deal. You know, that would just be for me a little bit too, you know, too off the map for me. Like, okay, I'm not making very much money. There's tons of risk here. And, you know, and they're collecting all these fees and making all this money. That doesn't make any sense. On the other hand, it's like, you know, if I'm scratching my head going, how are these guys making money? You know, that would be the other spectrum where I would want them to be compensated somehow, or have a really good understanding of how they're going to be compensated for putting the project together. You know, the average is probably somewhere in the middle. I know that's not a very good answer, but it's kind of the, you know, it's more of a perspective thing than it is, you know, well, the average is 2.6% acquisition and, you know, things like that. You know, I will say that some operators will charge it on how much money may have been raised, or how much the acquisition price is of the asset, or it might be on total project cost. So, you know, when you ask how much, well, what do you charge in fees? And they say, well, we charge a 1% fee. I would be curious, is it a 1% fee of $11 million, or is it a 1% fee of $3 million, right? It's a big difference. And you know, $30,000 versus 110. So, you know, just, I like to paint the entire picture and say, okay, I'm aware of everything that's happening. Acquisition fee, asset management fee, disposition fee, whatever it might be. And then the split is this. now I have a clear, like Sonia was talking about, now I clearly understand, I'm eyes wide open on where all the money's going and how everybody's getting paid. And I know what I'm looking for. I know that these syndications will typically charge some type of management fee, and I can be aware of those things. So
It makes sense. I guess the follow-up question then is, I would assume that a lot of the operators are doing more than one deal at a time,
yes,
right? So there's going to be income there, assuming that they follow your model. There's
Yep.
going to be income there across a number of projects. Yeah. Okay.
That's right. Yeah, and that's our model. We do, in our situation, we're doing 3 to 4 projects a year, and we're making our fees. Our fees are covering our overhead on the acquisition. For us, admittedly, kind of exposing ourselves a little bit. Property management is something that we prefer to do, but it's a loss leader for us. We're not really covering our overhead with property management fees. The salaries of the staff at corporate that focus on that division, we are losing money in that space. But we're okay with that because we feel that our alignment and our efforts to property manage are worth, the added weight to overhead that we have, because we feel like we can run the asset better than another company can. So anyway, yeah, good question though. That's a, really good thought.
Well, to the point that you just brought up when it comes to your own property management, assuming, in this case, when hey, I know exactly what I'm doing, I know how I like it, I know the consistency across all of the projects, execution, in this case makes sense, right?
Yeah.
And that's exactly what you guys strive for.
Yeah, and I'll give you another example. We have a property in Aspen Park, Colorado, and the minimum project property management fee that a self-storage property management company will charge is $2,500 a month. So that property takes in about, I think, maybe 17 or 18,000, maybe $20,000 a month. So even at 6%, they're not hitting or 5 or 6%. They're not hitting the minimum that would be required to do the property. So hiring an external third-party property management company in that instance would actually hurt the investor's bottom line. So our profit that we're taking on it is less than the minimum that a external property management company would charge. So we're actually kind of saving the partnership a little bit of money in that regard by doing it ourselves. So, there's a lot of little intricacies in here. I think a lot of investors look at the split. They look at the raw split at the end, but they fail to look at, everything else in the deal to make sure that it's comprehensive and not just about the split. And we can talk about splits on a different webinar. We can talk about, or different meetup, what's fair in a split, because there might be 15 hurdles before that split is achieved. So when you just ask that one question, what's your split, and you're judging the whole syndication on the split, the question is, what is the waterfall, and where does the money go on its way down, and what fees were charged and things like that. So great.
And on that point, I know, like, I gave so many examples of what other friends charge for project management fees, asset management fees, and things like that for different asset classes. Do you think it's worthwhile to focus on one asset class, or do you feel like it's attainable enough to kind of, pick a few, so to speak, and just understand the risk premium associated with, self-storage versus multifamily? Do you think that's, possible to understand it all?
It's usually, if you ask the operator, what's typical in your industry for property management fees, and they'll tell you. I mean, if you for those that have single family homes, that the fee is 10% typically, right? Am I wrong there? Right?
8 to 10%.
8 to 10%.
The fee is 10% right now. 8 is kind of more common, but
Yeah.
that's about it.
And if you have a higher premium for rent, the property management company might charge 8. If you have a lower premium for rent, they might charge 10, right? Because it's got to be worth their time, right, to manage and bring in your property and things like that. But I'm part of a apartment syndication. I've invested in apartment syndication. Their property management fees are 3%, and that is because it's a high volume of dollars, gross receipts. So the property management company is very worthwhile to bid on that. You know, storage, you know, again, it's around 6%. We actually do have third party at one of our properties that we've negotiated with down lower than that. I don't know if I'm allowed to say what it is, but you know, it's always negotiable. And that's sort of, you know, just something to be aware. You know, sometimes if you have to operate, what's typical in your industry, you know, because single family, like that's a great point. Single family is different than multifamily, is different than if they're different in size. If it's storage, if it's offices, it's, you know, it depends. You know, the industry has a, you know, kind of a normal standard. So, and I wouldn't get hung up too much on it, you know, but just know that that's something that, you know, they should be charging about what the market charges. There's nothing special about what anybody's really doing in property management. So,
one comment about that, Ryan, is that it might not be typically where a property management company can get over their skis is when they're not charging enough, and or they negotiate a deal with an owner that, you know, there's just not money in the budget to do the right things. So,
right.
I mean, I challenge people to go out and do the internet and look for property management companies and find all their reviews are positive. It's oftentimes they're just kind of the bad guy that is just doing the well, they're just managing to the lease and to their contract.
Exactly. That's a really good point. I mean, you pay for what you get, you know, and that's the thing. And that's why I say, you know, don't be afraid to, you know, pay your operator fees for running the deal. Cause, you know, again, hopefully you don't see the Maserati on the Facebook page the next day. And then they disappear from the project. But, you know, the fees are really the, you know, the thing that allow you to, you know, run a deal successfully. And it's the same as a property management company. You know, if they're charging bottom barrel pricing, you know, are you going to get bottom barrel service? You know, and that's really, you know, so we're never really looking to undercut or find the cheapest operator out there, because again, they care about one thing. You know, let's be honest. Any property management company out there is incentivized on one thing, and that's how much revenue they collect. Not how much they spend, not how much the property spends, not how much you make in tax payments or insurance or utilities or anything like that. They want gross revenue. So, you know, the investors, us investors, we care about net profit. So when you try to align those two things, you know, that's the key is, you know, and that's why I personally like, you know, managing our own properties, because I feel like there's more alignment that, hey, we're going to benefit from the split. Yeah, we benefit a little bit on the property management, but at the end of the day, that NOI is what's driving the value of the facility, you know, and, you know, things like that. So.
Hey, Ryan, I'll mention something. I've talked with property management companies for single family nationwide, and they say that they target 50% of their revenue comes from tenant placement fees.
Oh, wow.
Which is disgusting. You know what I mean? Like, yeah. That's what they do. And they charge about 8% for their management, but they get the income from, you know, turning over.
Wow.
So, yeah. I mean, you know, that's obviously not what you want in a property management company, but yet that's kind of so prevalent. I didn't even realize that until I talked with some people from the Fortune Builders community and some of these other education communities, that's really the case.
Sure.
So, you know, something like an in-house property management, obviously you're incentivized to benefit everyone because you're making way more from the deal itself than just the fees, right?
Exactly. It's a great balance.
Guys, this is great. We're coming 1 hour already.
Yep.
Let's just go through who else is in the call, just kind of, and who else has any questions. This is fantastic.
Everybody can unmute that wants to speak.
Yeah.
Andrea, you want to go? And maybe Yuri, you can go after Andrea.
Sure.
That was Andrew. Andrew.
Oh, Andrew. Oh,
yeah, Andrew Zverev.
Yuri, go ahead. Jump on in. By the way, the gentleman that I mentioned wanting a passive meetup, we can thank Yuri for that. So thanks for inspiring me.
Can you hear me, guys?
Yeah, we
Yeah.
can hear you.
Okay. Hi, everybody. So I'm kind of not a typical real estate investor. I'm a full-time physician. So kind of getting a little bit of burnout, and maybe a year and a half or 2 years ago, thought, okay, maybe I should do something different, or at least look into it, because I had been investing in the stock market, relatively successfully, mostly passive index funds, but really didn't know anything about real estate. In fact, it was kind of scary to me. So I started going to meetups, and this is how I actually met Ryan when he presented about storage facilities. And I have to say I learned a lot, just going by meetings and talking to people. So I purchased a duplex in Bellingham last winter, kind of a house hacking. So I'm living in one of the units, renting that one out. And the more I learn about real estate, the more I realize that, at least for me in this current situation, passive investing is probably the best way to go, because I just don't have a lot of time, and really not interested about managing apartments or multifamily or single family, and dealing with contractors. I kind of had an unpleasant experience, which I suspect everybody would go through. So it was a good learning experience. But as I was going through it, I'm like, oh my God, why am I doing this? So I think for me, the most important thing would be to find a reputable companies that do syndications, and I'm willing to make less than I would make doing something else, but at least have professionals deal with that. But obviously I need to know and understand the business, make sure I don't get taken advantage of, and there's obviously a risk. So I've invested, I don't know if I'm allowed to say, with Ryan's company for, gosh, quite a few.
5 deals.
Yeah. I think the one that I was really scared about was just a little bit of different type of investment. But what I like about these organizations, just like Ryan's, they really specialize in certain things. And I think learning about the risks associated with passive investments, most of it is the execution of a plan. And if you have a company that has been doing the same thing over and over and over, I think the risk goes significantly down. So that's, but I'm still learning. This is all new to me.
Well, thanks for the kind words, and welcome. We're here to better, that education and enhance the learning in the space. And hopefully when we can meet in person again, we'll have that. So
Absolutely.
Vicky, did you want to jump in?
Hey, Ryan. This is Murat, actually.
Oh, hey, Murat. Hey.
Hi, how's it going?
Hey, guys.
So, maybe kind of to piggyback on Yuri, I'm actually a physician also, and we're investors out of Atlanta, and have been kind of interested in investing for at least the last 3-4 years, and kind of the story is very similar to yours as far as the reasons why. My job's pretty busy, so is my wife's, and we're kind of looking to make our money do as much work as we're doing. So we've done everything from single family, private lending for kind of rehab flips. We've done a lot of multifamily investing over the last 2-3 years, and are kind of just looking to diversify kind of the different deals we invest to. So out of multifamily kind of grew, different sectors like industrial and subsectors such as, storage facilities and things like that. And I think that's how we came across Ryan, and have invested in a couple of deals with Ryan so far. So we're learning, looking to learn more about kind of not so much necessarily just from the investor side of things, but also from the operator side of things, because, helps us to make better decisions when we understand how you guys think. And again, kind of like you said, Ryan, what makes a deal kind of function, and kind of what's built into a deal, so that you don't have any surprises on the back end. As far as fees and things like that. And at some point, ideally, one day we might become more kind of active in a deal, and would love to be more involved in the operations of that. So I think before you can do that, you really have to learn through investing and understanding all the basics of a deal before you really can try to become kind of the operator or syndicator, and kind of really looking to network, to see what other people are doing, and to kind of learn what works and kind of create a system.
That's great. Yeah. Thanks for the nice comments. I think, a lot of folks that ask me like, hey, what should I do to get involved and do my own syndication someday? And that, other than learn as much as possible and meetups and podcasts and books and seminars and things like that, just invest in a deal, because you're going to learn a lot. You're not on the stage performing, but you're in the front row, and you got a front row ticket to exactly what's going on. And all of our investors, one of our core values is radical transparency. And anybody who wants to spend time talking about a deal, or asking questions about how we set something up, we're always very open to that. And that's a great way to learn without the stress of having to do it all the first time on your own. So I know you guys joined us from Georgia. We had a meetup last night. And I said, hey, come, this is virtual for now. It's a Seattle meetup. Maybe we'll do it Zoom when we get back in person, but, or have you out sometime. It's beautiful, especially this time of year in the Pacific Northwest. So, but great. Well, thanks, Murat and Vicky. Appreciate it. Anybody else that would like to introduce themselves, and then we'll wrap up.
I'll probably jump in on a quick word, because haven't introduced myself, and something that Yuri and Vicky said. My name is Igor. I've been in real estate industry the past 3.5 years, and always been curious about the investment side of the business. Read Kiyosaki book, got a few mentors. They're like, hey, you should just jump in and start working, and you'll be learning this thing in and out. And over the past years, been working a lot with builders, developers here in Seattle on the east side. I work in Bellevue. And I've been learning more about multifamily, but on a smaller scale, right? Like 2 to 4 units. And what you said, hey, I did house hacking, right? Like in Bellingham. So I was learning a lot about that. And I have investors, and I talk to people that usually would buy a few single family homes and keep them in rentals. And I say, hey, like you could do this, right? You can do 4, 5, 6 units. And I saw that it was hard for some folks to kind of swallow that idea and really shift their thinking from single family to multifamily. And then the few that did, it was really hard for them, right? Because if you've never done it and you need to figure it out, like how to work with those contractors, right? Or you could have bad experience, or how do you manage? Do you self-manage? Do you find property management company? It's kind of hard and unknown, and there is a lot of money involved. And then the more we've been looking for those deals, everyone wants one of those deals from the people that actually know what they're doing, and it's really hard to find. So me and Tyler, we met at some point back in the day, and we just thought, it's just time to kind of think bigger, because in those syndication deals, you can make the same return, if not better, and you actually don't have to do the work and deal with those contractors and so on. So it really comes down to, some people really like control, and they really like doing it. And sometimes, it's great. One single family, or you buy 2 units in Bellingham, or maybe 3 more somewhere else, and that's fantastic. But I kind of really, and we reached out to Ryan, and we're like, hey, we want to also learn about larger things. Like you could have a smaller percentage of ownership, but the deal itself is so big that you actually end up making more money, and not really do the work, but trust someone who really knows their stuff. So this is just our introduction. Super pumped to be with you guys, and hopefully we'll have a lot of great content in months to come, because we're just kicking this thing off. So
absolutely. Thanks, Igor. That was great.
Who else we've got? Anyone else? We're not going to push people if they don't want to talk, but yeah, it's been our 15 minutes. If anyone else has some to add, go on.
Yeah.
I'll say hi real quick. This is Mark Canton. I'm a fan of Spartan and what they have going on. I've known those guys for quite a while, and I invested in one of their deals. I was way too distrusting to invest in a syndication for years and years and years, but I got over the hump. I invested in the 285 RV park, and I just really enjoyed getting to know the guys, and really excited about what they have going on. Not just to butter him up because he's here on the call, but I will say I really appreciate what you're doing with the investor knowledge, which I know it's part of Ryan's role in the company, but I've also seen other people doing knowledge type events, which is really just kind of a disguised marketing technique. And there have been one or two cases where after the fact I've learned kind of what we weren't being told and how we're being kind of shuffled into things. And they're smooth about it. They're very smooth about it. But I'm just really glad that, Ryan's a pretty wholesome guy and just tries to do this and do his best for everybody in the community. So glad to be here. I've also had the opportunity to work with Tyler a little bit. Really appreciated that. He worked his butt off. So thanks for putting this on, guys.
Yeah, you're welcome. And Mark's being humble. He does all of our taxes, so.
Yeah, and it still took me a while to say, well, I don't know if I'll put my money. No, I'm just kidding. That would actually be a great endorsement. If I wasn't such a private person, that would be a good endorsement, is that I've been seeing your books inside out for years, and now I have.
Mark, how many K1s do we send out every year?
Oh,
the 300? What?
It's a lot. It's a lot. I mean, the recent deals, the cap table's been really large, right? There's been what, 30, 40 investors, things like that.
We'll talk about K1s on another call, and maybe we'll have Mark be the speaker on that. Part of these syndications is you get K1s, and there's a 1065 for the business that you've invested in, and then there's K1s that come out, and Mark's team does a great job getting those K1s into our investors' hands, hopefully no later than March 31st. That's a whole other topic, but ideally you want to have your tax returns back so you can do your tax returns on time. So hats off to Mark and Hunt Jackson for that. So
awesome, great, guys. Well, if anyone else will go in.
I think Amit wanted to speak up. Are you?
Yeah, hi there. Hey guys.
Hey.
I just wanted to appreciate all the info that you guys give and all the new topics, the hot new topics that you guys bring on the table. So thanks to Igor and Tyler and Ryan. There are two topics I think if we can cover sometime. One is on student housing, if like there are any good opportunities there. And the other is, how have contracts changed since COVID? So when we sign new contracts, what are some of the things that are different now, right? Like security deposits, clauses, legal clauses, so on and so forth. So I think it'd be great to have that discussion sometime.
Yeah, we definitely put this one into consideration. As of right now, we're looking to do this every 2 weeks. So you can be certain to put next Thursday, whatever the date is in 2 weeks, 4:30 p.m. on the calendar. If I'm not mistaken, it's September 10th.
Yeah.
And there are a bunch of topics just like this. Very good question, actually. Amit, thank you. That we could be discussing. So we're just going with a top priority. We could have conversation on this one. We'll take it in consideration. So you guys mark your calendar, September 10th, 4:30 p.m. We'll send you an email with another registration link here soon. And I always say, if the purpose of syndication is spread the wealth, right? Like share it with other investors. So far we're spreading the informational wealth with all of you. And if you spread it with at least one of your friends, feel free to invite a good, I hate saying qualified, but qualified in the way that they want to learn and maybe act in the future friend to our next meetup. We'll be grateful, and you'll help us to keep this community grow.
Yeah,
that's what I have. And Ryan, yeah.
Yeah, and I was going to say, we're not advertising this. We're not blasting this to the world. We're not trying to make this 8,000 people. We're just trying to build a small, if it gets big, it gets big, but we're trying to keep this quality, interactive, relationship building, nice nucleus of people, where it's not just, anybody and everybody. I mean, if you noticed, we haven't put this on social media. We are doing a YouTube channel, and we have the recordings go on the YouTube channel. This will eventually, just the content piece and the presentation piece will go into a podcast. But that's mostly just to get a replay for people that missed the last meeting. we're not really pushing this that hard, you know, because we're not trying to be the sell a dream, as Mark Canton says, or, you know, how to, you know, buy your next flip or something. It's just to really focus on the education for syndication and, you know, get some good conversations going with that. In an environment that doesn't have any pressure of a specific deal or making a decision. It's just kind of like a relaxed environment to learn. So that way, when you're presented a deal, you're more sophisticated about, you know, what am I looking for? What am I not looking for? You know, I don't want to turn this into a pitch fest. One thing I would like to do, though, is I would like to bring in operators that I know, like, and trust, and that Igor and Tyler know, like, and trust. Yeah. So, for example, I invest passively with operators that do an amazing job, and unfortunately, I invest with operators that do a terrible job. So I would love to bring in those good operators and have them speak and talk about what they do, and maybe learn from them. You know, you know, mobile home park, multifamily, you know, et cetera. And even, you know, even some competitors, some storage competitors that do a great job that I would recommend in people investing with. You know, that's the type of community. It's kind of like really good due diligence, good education, and good quality opportunities for investors to consider. So, but with that, we're going to wrap up for tonight, and I appreciate you guys all coming, and we'll make sure you're on our email list. We've been emailing out in advance the registration link. There's also meetup.com. I think it's called like Passive Real Estate Investing or something, but we'll change it soon to Investment Syndication Simplified. And
make sure to subscribe to our YouTube channel because I feel like I'm the only subscriber in there. So so you guys know where to look every 2 weeks. Content will be going in there. So just subscribe and
it's called Investment Syndication Simplified, and you guys are the founding members. So anyway, thanks everybody for your time, and enjoy the rest of the evening.